Hi, everybody. Welcome to our DAT IQ weekly market update. This is our update for January the 27th. Another month is already in the books for the start of the year. Time's flying. It's episode 324. I think I've got that right. I'm Dean Croak, analyst here, along with Dan Deigan. A lot of you may know Dan from Logistics Life of podcast fame, more recently at Pinnacle Logistics at 3PL here in Canada. Dan, for a lot of people don't know, you and I do a weekly podcast called Day to Day Wednesday. How long has that been that we've been doing that?
Geez, I think we're going on a year and a half at least, Dean,
Yeah.
if not long. No, hold on. What am I talking about? We started Data Day during COVID,
Yeah.
so
Yeah.
we're going on a couple of years now, actually,
Yeah.
because you were running it with
While you were off sick, we had Ryan and Jeff.
That's right. You were on with Jeff as well. So yeah, when Ryan and Jeff, so we're probably going on close to 3 years of delivering data every Wednesday to
Yeah.
salespeople in logistics. That's pretty cool, actually.
And shocker of all shockers, we've been pretty accurate, right?
Yeah. Oh, you know what? We have been more accurate than most, I would say.
So, yeah.
Well, let me rephrase it. You've been more accurate than most, let me say, on multiple occasions. I just kind of tag along and ride your coattails on Data Day, buddy. I got to tell you.
Okay. Hey, a lot of folks won't know you, the broader brokerage world here in the lower 48. If they don't, tell us a little bit about what you do at Pinnacle Logistics and what they do.
Sure, definitely. Well, I'm the director of sales at Pinnacle Logistics Solutions Limited. Originally, Pinnacle was a major project company responsible for a ton of the wind farms, a lot of the solar farms, mining, those kind of industries, doing multiple projects across multiple different planes of transportation, air, ocean, OD, all that kind of stuff. Responsible for a lot of modular buildings as well. We were a big part of the 141 Bay Street modular complex build downtown.
Mm-hmm.
We do a lot of work with some large companies, and projects, for lack of a better term, range in that like 300, 400, 500, 600 load basis on a single source. Doing a lot of stuff up northern Ontario, and about 9 months ago, started to really look at opening up a supply chain division, because obviously, like, Dean, I reverted back to what happens with a lot of carriers, right? You have a core central nucleus of your company, and then customers start wanting more and more and more. And Pinnacle saw an opportunity to grow and develop, so they brought me in to lead and build that supply chain division. So we're cross selling or cross servicing, if you will, a lot of clients on the day-to-day freight side that has nothing to do with projects, as well as the ability to incorporate projects into the mix for a lot of our day-to-day customers.
Got it. Well, we're going to learn more about what you do in Pinnacle and the Canadian market. We're going to dive into the LoadLink report as of the end of the year. So I'm going to jump into the freight market update for the lower 48, and then we'll come back and talk more about what's happening north of the border. We'll bring you back in a bit later.
Sounds good.
All right, so let's dive into the market update. Some key things we're watching this week. I'm just back from India, so excuse my croaky voice, but we'll get through this the best we can. A couple of things we're watching last week. Spot rates did cool, ending the week at about identical to where they were in week 4 last year. Of course, there was some regional impact in markets impacted by the cold. But across the board, capacity eased last week on a lower volume of loads moving. Of course, it was driven by Winter Storm Enzo, dumping record levels of snow from Houston to the Carolinas. One soundbite I heard that was quite fascinating: there was more snow on the ground in Louisiana and Florida than in the Dakotas and Iowa. There's a couple of more storms coming through this week. We're getting hammered here in the northeast. We just had an earthquake this morning here in the northeast part of the country. I don't know how bad it is. Another 2 storms coming, one in New England, looks like Wednesday, and another second one looks like going to hit the Midwest. So we're not over with yet in terms of the storms. The other news we're watching, truckload tonnage decreased in December. So it was the first time since March and April that tonnage had contracted for 2 consecutive months. It was down 1.8% in November, down 1.1% last month, bringing a 2-month total decrease to 2.9%. So tonnage is at its lowest level since January of 2024. which is an interesting data point. We talked a little bit about that last week. Of course, earnings seasons is underway. Some good news came out of the Knight-Swift earnings call last week. CEO Adam Miller noted the trucking contractual bid season rates are increasing, and they've been trending toward mid-single digits, with signs that the market is becoming more balanced. And in brackets, that means improved customer sentiment, seasonal spot rate progression, and further capacity exits. Also supporting that was a post by Jason Miller today on LinkedIn. He produced the BLS's Producer Price Index, showed a year-over-year increase of 0.8%, despite prices for diesel falling. The PPI is still down 23% from the high observed in May of 2022. And lastly, this week's market update, the long form version of this report will be out this evening. You can download it at dat.com/market update. In this week's update, we're looking at the history of the Omaha stockyards and the Nebraska reefer market, more on Jason Miller's truckload ton mile index, California wildfires, and some of the impact on produce growers ahead of the produce season starting to wind up there. There's considerable damage to the southern end of the Imperial Valley right now. All right, so let's dive into some of the data points. Load to truck ratio, of course, the market slowed last week towards the end of the month, most likely impacted by freezing cold temps. Load to truck ratio ended the week at 6.27. In refrigeration, capacity also loosened last week. Load to truck ratio ended the week at 10.69. And the load to truck ratio in flatbed ended the week at 21.43. Record cold temps and snowfall in the south last week resulted in some regional markets grinding to a complete halt. This, along with colder weather in other larger markets like Illinois, Indiana, and Ohio. Volumes were down 17% week over week last week. So certain markets were affected more than others. But nationally, 21.43 was the flatbed number. In the year over year look at spot rates, despite a national decrease in capacity last week and unprecedented weather in the south and southeast region, capacity did tighten in those regions, not surprisingly. Along the Gulf Coast, line haul rates are up 6 cents a mile, particularly in Tallahassee, Mobile, and New Orleans, where the snow was its most impactful. At the national level, the 7-day rolling average ended last week down 5 cents a mile, settling at $1.76 at the end of the week. Spot rates are about 1 cent per mile lower than last year and about 2 cents per mile lower than in 2019, based on an identical volume of loads compared to last year. On our top 50 lanes, ranked by the volume of loads moved, carriers received an average of 209 last week. Remember, these are line haul excluding fuel. That's a decrease of 5 cents a mile last week and about 9 cents a mile in the last 2 weeks. So our top 50 lanes decreasing. That's about 33 cents a mile higher, though, than the 7-day rolling average of $1.76. It's been sitting at about a 33 cent per mile spread for a couple of weeks now. In refrigeration, rates continue to cool following another 5 cent per mile decrease. It's led the national average to about $2.11 a mile late last week. That's about 2 cents a mile lower than last year. Looking back to 2016 and excluding the pandemic influenced freight markets, last week's 7-day rolling average rate was 12 cents a mile higher than the long-term week 4 average of 201. Just to put that into perspective, rates are better than where they would normally be going back over the last 8 years. The 7-day rolling average for flatbed has averaged $2 a mile for the last 2 years, and that's exactly where flatbed rates ended last week. At $2 a mile, line haul rates were down 2 cents a mile last week and remain almost identical to where they were in 2019. All right, so we don't have Chad today. I'm going to go through the short-term forecast and then talk a little bit about the contract freight market. These are our rate view forecast out 35 days using our flagship RateCast product. So these are line haul only. They more heavily weight seasonal long-term trends, excludes fuel, so pure line haul. A couple of color codes there. The blue is the 7-day historical. The green is the RateCast forecast out 35 days. The yellow or gold line is the upper band, and the red is the more pessimistic lower band. And as you can see there, RateCast is thinking that rates are going to be down about 4 cents a mile out to March 1st, ending that period at about $1.70. So a little bit of a slide in rates there. Low case has them down 12, high case up 3. I think where we're sitting right now, RateCast is going to be pretty well on the money, as it has always been. In refrigeration, in dry van there, Rates are at $1.70 compared to last year. They're about $1.95 as you started to get into March. So a little bit lower than last year, but that's pretty much where our forecasts we're thinking we'd be this year at that juncture. In the refrigeration market, Ratecast has got spot rates down 7 cents a mile out to March 1st at $2.02. Low case has them down 15. High case has them flat. And last year rates were $1.85, so a little bit higher than where they were last year heading into that period. And in flatbed, Ratecast has them flat out to March 1st at $2.01 per mile, low case down 4, high case up 6. Last year they were $1.95 at the March 1st juncture. So the forecast has got rates in Ratecast at about 6 cents a mile higher than where they were at that time last year. All right, so that's our national forecast for the spot rate market. In the other side of our market, and I'll quickly pull those charts up so we can have a look at them. The national forecast or rate development for new rates in the contract market based on our shipper consortium. The NRD is the new rate development that I wanted to look at today. These are a little bit different charts than what Chad had, but essentially it's a short-term view of where we see active and replacement rates coming into routing guides. Active rates are essentially the average of all of the rates used repetitively in routing guides. And in dry van, as of 1/23 last week, they were down 0.7%. They've been up and down within that 1% range for quite a few weeks. Replacement rates up 0.8% compared to the prior week where they were down 7%. So similar sort of up and down trend around a 0% year over year change. That means that the replacement rates, these are brand new rates entering routing guides for the first time. So these are essentially new rates based on a recent RFP. That chart tells us that new contract rates entering routing guides are about 1% above those being replaced, which of course supports some of the views that Adam Miller, CEO of Knight Swift, reported in their recent earning calls where they're seeing some upward trends in their rate development. If you look at that blue line there on the dry van, you can see for the last year, rates have been trending up, getting towards that 0% year over year change, slightly above it now. So that's some positive news in van, not so in temp control and flatbed. Active rates, the ones in the routing guides that are used repetitively, still down 1.1% compared to 1.5. Replacement rates are down 0.2%. So they're struggling to get above that 0% year over year break even line. And in flatbed, active rates are up a little bit, but replacement rates are down 5.4%. You can look at that blue line on the flatbed and see how far below 0% year over year it's been for quite some time. Supports what we covered a little bit earlier with flatbed, where rates were down at around that $2 per mile mark, and been averaging that for that almost 2.5 years. All right, so that's the end of our forecast period. What I'd like to do now is bring Dan back in. Dan, let's talk about the Canadian market to start with. Question of the week that I sort of would like to throw at you is the Canadian market ended last year strong. Use the quote from LoadLink. They thought that demand was higher and supply was lower. How did you see the year end?
You know, I'm going to say it was, I'm trying not to create words on you here, Dean, but it's pocketized. And what I mean by that is, you know, it's kind of like the geographical analogy, but very pocketized. So certain areas of Canada, I mean, rates ended way higher than where they started. And I think that's given, right? We had, you know, strikes at ports. We had issues with rail. We went through a lot last year.
Yeah.
So, you know, even the CP kind of escalation, customers were putting stuff on flatbeds and destuffing containers, and then all of a sudden trucks going north and south. We've had huge pockets of snow squalls. Northern Ontario, things like Muskoka, you know, 3 feet have fallen. We've had things like carriers on Highway 11 going north because of the way the bypass works in Northern Ontario. There's really only one way to get out to Winnipeg if you don't want to come through Minnesota and all that. You know, there were people that got stuck on the highway and literally 3 hours later were buried in the snow.
Wow.
So we did end higher. We're seeing rates now in the Canadian market much higher than they've been. to the point where we're starting to have conversations with customers and saying, we're hitting a few anomalies in our regular rates that we have in place. In Canada, we don't necessarily call them tariffs, but we have standardized rates that we put in place for customers. Was just on a phone call with a customer last week where we were looking at options to help them win more business, because what we're finding is in the Canadian market, and I'm sure it's the same in the US in certain areas, the freight is actually pricing us out of opportunities for our customers. So meaning customers are creating product for customers. When they add the freight in, Dean, it's pricing us out. I mean, we are looking at multiple options, consolidation on rail, pool distribution instead of hub and spoke. We're looking at everything. But I'm going to say on average across Canada, yeah, we ended the season probably up. I'm going to say anywhere between 6 to 10 cents a mile in certain locations.
That's interesting. I did pull some rates this morning from RateView, excluding fuel. Just I'll run those by you. US to Canada over the last year up 3 cents a mile. Canada to the US up 1 cent per mile. Internal Canada down 15, but not high volumes. And one of the big lanes that we watch is Toronto to the Great Lakes, up 6 cents. So it's a high volume automotive lane. The big lane that you follow, Dan, of course, is Toronto to Montreal. That's correct.
Yep.
Those rates are still about, I could quickly pull that up. I think they're about $708 a mile, a load. That's about $15 a load higher than where they were a year ago. But essentially that looks like a very flat lane. Is there a lot of volatility in that lane, or is it pretty balanced bidirectionally?
The thing with Toronto, Montreal, I think it's a big repositioning lane in Canada as well. And it's probably the heaviest lane in Canada. So prior to COVID, it was $1,300-$1,500 was most numbers for that lane.
Right.
So we're actually down a lot on that lane.
Right.
I do recall in 2018, some of the numbers in that lane was down around $350.
Wow.
Typically, when you look at the Toronto Montreal lane, if you're looking at a Canadian market, it's usually the first lane where we get hit, in my view. When we see things like rail and OTR kind of doing this, because on rail, you're right around that $500-$600 mark. Right. When you start having that minimal distance between the two, people are obviously going to go over road because they don't have to deal with the Mississauga in-gate terminal. They don't have to deal with the Montreal outgate terminal, or even like all the West Island outgate terminals. And they can drive straight through. I can tell you, my neighbor actually drives for a very prominent cartage company up in Canada. And he said, Dan, the Toronto-Montreal corridor right now is a nightmare. He says it's just like everybody's trying to pass everybody, and they're doing, 1 kilometer faster on the floor from being limited. And he's finding his actual routes are taking way longer. Obviously, with the snow and everything, they're getting rerouted. He's sometimes at night, he's rerouted 3-4 times on the way back to Toronto from Montreal.
Yeah, I was on that late last year, coming back from the truck show in Nova Scotia, heading up towards your area. That was eye-opening, how much traffic there is on that fairly condensed part of the world.
Yeah.
Dan, I just look at some rates here in RateView. So we've got contract rates on Montreal, Toronto sitting at about $870. Now I'll quote you all-in rates. That's $870 a load on the contract side. On the spot side, the all-in is at $708. But then essentially flat. I mean, they've been going up since about October, but up probably $100 a load since October. Does that kind of fit with what you've been seeing when you talk about demand tightening?
Yeah, fairly. Also, we, Toronto Montreal corridor, we also got to understand there's a lot of companies that will fill their trailers on rail, right? So they're literally doing P&D in Montreal and then P&D in Toronto, P&D in Toronto, putting it on rail, going back to Montreal. So it can remain very flat when it comes to these processes and what we're doing. What we're finding a lot based on just this kind of Eastern corridor is a lot of it is transloads that we're seeing actually. So we have a lot of customers coming into the Montreal port, warehousing in Montreal, and then spitting stuff out when they need it, as opposed to just doing a direct run through, which is an interesting thing to see, especially that, we were talking a couple of months ago about all this product being pulled forward and so on and so forth. But what they're doing is they're utilizing better costing on warehousing in Montreal, as opposed to spending it in Ontario, because the cost per square foot in Ontario is so much higher.
Got it. Dan, you mentioned something a minute ago. I want to come back to it. You're talking about the cost of transportation for your shippers was pricing them out of jobs they were quoting on.
Yeah.
Who were they losing the jobs to?
So they were actually losing them to local companies that don't have as much reach, and actually losing them to US companies as well.
Right.
Which, for me, Dean, during that conversation, I probed into that. 6 ways from Sunday, I started asking, how are we losing it when the dollar, so you have 32 34 cents a dollar, every dollar additional increase plus the transportation. And they were saying, we're not sure how they're doing it, or how we're getting priced out. So we actually put more of an expedited LTL program together for them over the last couple of weeks. We should be releasing it this week, and hopefully they'll get some of that buying power back.
Wouldn't it be some of your, your Brampton carriers quoting low rates to come back? Could that be part of it, making the lower cost northbound?
Yeah, this is one thing we've noticed that has changed, especially in the Canadian market. A lot of companies in Ontario that used to send trucks out west are no longer going out there. And it's interesting because I started having conversations with a lot of people, and they said the training, the drivers just don't want to have to deal with chains. They don't want to have to do that. So I think what's happened is, I think it's kind of gone twofold, Dean. One being, I think drivers are getting more particular about where they go. For example, in conversations with a couple of carriers, one of our big things that we do here at Pinnacle is, when we find a really good carrier, we find out, where do you want to go? Where do you want to build your business? And when we start exploring these different pockets that they want to go to, we ask the questions, okay, why this pocket? And it's, obviously easy drive. Our drivers just really want to drive. They don't want to have to chain. They don't want to have to go through these weather pockets. Now, when you're chaining in Florida for an anomaly this year, maybe you've bounced out of that, but it's one of these things where we're asking, and less, kind of like what we saw during COVID, where less and less companies were renewing their hazmat certificates and their hazmat authorities. And so all of a sudden, there's less and less. So it's a very specific driver that says, yeah, I'll go out west, no problem. Especially in this season that we're facing. Like, this is the first year, I don't know about you in New England, but for us, it's the first January. We haven't had a January thaw. And there's no sign of having a thaw, which for me as a snowmobiler is a awesome thing to have. But most people, we've shoveled more in December and January than we shoveled the entire winter last year. Right. So that brings on new elements for drivers going across Canada out west. There's a lot of projects happening in Western Canada. We are seeing a ton of new production of steel and aluminum in Quebec. Markets are growing. And I think a lot of it has to do with the US Canadian politics, and we're all going to kind of fend for ourselves, but we're going to grow. But the amount of stuff that's happening is crazy. And if it continues and we don't train drivers to do it, these prices are going to start skyrocketing.
So we've come full circle from, basically too much capacity, some bankruptcies of some well-known companies, government subsidies, rate cutting, paying drivers too little, winning bids on much lower, unsustainable rates, to the opposite now. That's happened within the space of a year, which is pretty quick. So do you think that demand, that a lot of that demand that you're talking about from the US side of the border would have had to have happened before the last, our national election, our federal election here?
Yes.
So what do you think is driving that? Is it obviously more demand here, but have the Canadians had to do something differently to be competitive?
No. So, I think there's a few things driving it. I know, I've spoken to you quite a few times about my brother-in-law. He's into, his business is the robotic arms that do welding in factories. And he's noticed a massive increase in US sales.
Mm.
in probably the last 5 months, I'm going to call it. So 4 months leading up to the end, starting in September kind of thing.
Mm.
He says, Dan, we almost can't even keep up to it. And I asked him, because obviously robotic arms are a big purchase.
Mm.
And I said, do you think it has anything to do with the whole tariff conversation? He says, oh, probably. People are looking to get stuff bought before. But I think what's really happening, Dean, if we were to dissect this to its really core, its center, is I think based on drivers, I think they're having a lot more power in dictating where companies go. Because a lot of companies that I'm having conversation with, and I'm going to say probably 75 to 80% of them, when I'm asking the questions, okay, where can we help you grow?
Mm-hmm.
He's like, majority of the time, it's all my drivers want to go here, or the most of my drivers want to go here. My drivers don't want to do New Jersey. They don't want to do. And so it's finding these companies that are going to go to these locations that can serve our clients at the levels they need served, but also keep them competitive in the market. So I think I really think this year in logistics, as a logistics professional, you've got probably 3 to 4 levels that you're having to work with a customer on, right? What is your tech? How is your tech going to save time, energy, and money? Because we all know, right? Logistics, or freight, if you will, getting your product to market is a huge expense in a company. But is there other areas where you can mitigate costs in order to allocate it to that freight, right? So one of the conversations with this company was, how can we introduce tech to streamline a lot of your stuff? So streamline the salespeople in the company. So as a logistics provider, looking at tech to help streamline our customer salespeople, right? And reducing the amount of, and I don't mean getting rid of jobs, but reducing the amount of redundant tasks. So that's number one. Number two is, if you're not having a conversation with customers about how they stay competitive, you're missing the boat. Number three is building those relationships with really solid people that want to grow with you, right? And obviously, number four is, I personally believe, and we've talked about this a few times as well, is really understanding where you're going, what you're doing, to help the driver be as productive as possible.
Yeah.
Right. And companies all around are consistently looking at it and saying, like, my drivers won't go there. I've got nobody to do this. Like, we had a couple of loads the other week. Driver was doing a round trip, and the driver got sick. And we had to literally book a different company in, because none of the drivers would take the freight.
Yeah.
And it was an OD load, tarping, like, it's a rough, it's a rough drive when you're having to tarp, and, we were minus 27 last week. And, it's not nice to get out there and tarp a load, but I think they're really dictating more than they have in the past.
Dan, knowing a lot of Canadian drivers, they are more creatures of habit than most. But the other thing, though, Dan, is with cabotage rules, you've got to run back, to Canada, loaded across the border. Not that people don't do intra-US loads on the quiet, but essentially, I remember you said to me, or Chuck Snow said to me, you don't leave Canada unless you've got a load home, because you've got to load back. And I wonder whether part of that is the tailoring of the work around drivers to their domicile address, like the lanes they preferred to run, essentially get them home every weekend or every other weekend, whatever the situation is. So I wonder about, how much that's changed, or is that still the same? Because remember when May of 2022, we were talking about the mask mandate protests at the border, and it was estimated that about 25% of cross-border drivers had just simply said, we're not going to the US because of their mask mandates. And of course, capacity tightened and rates went up. I wonder if that's part of it, is drivers have got a little bit more pricing power back in the market, especially on those smaller fleets where they run dedicated lanes for their shippers.
I wouldn't doubt it. I remember when my neighbor was slow with work, I said, why don't you go to the US? He says, no, not interested. I'm not interested in crossing the border. I'm not interested in dealing with all that garbage. He goes, I'd rather do like Windsor, do a drop and swap in Windsor. I know companies that are doing that now.
Yeah.
They have specific drivers that will do US, Canada, and other ones that won't. So they're swapping trailers in Windsor and coming back, looking at like staging yards in London. And I mean, I think it's shifting their entire process.
Yeah.
for carriers.
Who's doing the cross-border piece across the bridge there, though? If you're doing a drop and swap at, say, on the Windsor side of the border, someone has to cross the border at some point.
Yeah, so it would be a U.S. driver, mainly from the conversations I've had. Younger, newer drivers don't necessarily have a family, not looking to be home every night. They kind of want to be on the road, and they're swapping with drivers that used to do line haul, which are now doing more or less long. I call it long city work.
Right.
Where it's longer distances, 3-4 hours out, 3-4 hours back, 1 or 2 pickups, your day's done.
Yeah. So Dan, you and I've been talking for a few years. The market hasn't been healthy, but it sounds like it's starting to pick up. Capacity is starting to rebalance. Is that, for the best part of last year, we talked about excess capacity in the market. Do you think that's in our rear vision mirror? Like a lot of those companies that were questionable?
Yeah, I think so, Dean. And I think a few things. And one of them is, if you look at the headlines, if you look at the conversations in group chats and this kind of stuff, it's not all rose-colored glasses, right? We go back to when you and I first met, 2018-19, right? 2018, prices skyrocketed. Everybody was like, this is like, everybody's doing the old, we're making money in logistics.
Right.
So many carriers came in, flooded the market, prices dropped, people went out of business. Then we had that huge issue in 19 where, sell it on and da-da. And I remember you and I speaking going, I hope people learned about what happened. I think the same thing happened with the pandemic. I think the same amount of people, they did the same thing. They jumped in. I mean, you look at companies that would manufacture plastic, whatever. And then as soon as the pandemic hit, they were doing gloves, right? They were doing PPE. Like if you looked at how many of those companies just pivoted on a dime to do this, I think the same thing happened in freight. And I think from what you and I have spoke about from during the pandemic, so much money was made. And the carriers that were smart had that long runway. And, you and I spoke about it leading up to December. And I remember we said, the reality is if we do not have a really good December, I think people are just going to dissolve, because at what point do you stop throwing good money after bad? Right. And in our market, right, the majority of freight is a backhaul market. Now, some people might say, there's no head haul, there's no backhaul. I mean, a mile's a mile. But when you look at it from a Canadian perspective, which is the exact opposite from a US perspective, when we go to the US and have to refuel, we're refueling at usually 25 cents more per dollar than we would fuel in Canada. Now, you take that with the flip side of it, right, of Canadian liters versus gallons, we're still paying higher prices right now than California. It's crazy, but now we're dealing with the US exchange. And so I look at all of these factors. I look at the factor that customers are wanting better pricing. Customers are still, in my opinion, rivaling from the pandemic and having to pay so much. Like every customer I speak to, when they're like, okay, we need to do this and this, but we got to be conscious of price. It's not just, and I'm talking even anything from warehousing. Like, again, warehousing in Montreal is cheaper than warehousing in Toronto. Right. It's just the economics of the two facilities and what a cost per square foot is, in and out fees, pay, all that kind of stuff. There's a difference in every province. We're warehousing in Edmonton or in Calgary because it's cheaper than Vancouver. Same thing. And even with the freight, it turns out to be cheaper when product's there for X amount of time. So I think what customers are doing is they're still looking for the individual or the company that will come in and give them the tools, the resources, the ability to think outside the box. And with that, I don't think people that would open trucking companies to make some money and leave. I think it's the long haulers that are now in the industry. The people this is a career. It's not just an opportunity where I can throw a couple of $100,000 at it, pay some monthly fees and make, 4 million and then get out. Right. And I think we see that in the used truck market as well.
It's a fascinating market. I was chatting with a friend of mine that runs some fresh lobsters out of Nova Scotia last week. Dan, 7-figure loads of live lobster into JFK in New York City, like highly specialized. Like they're not in the same world that you and I have just been talking about, which is in that freight of all kinds world. It's a really different business, but that's trucking. It runs from the really high-end specialized carriers to the carriers that don't have lots of differentiation. Dan, we're up on time. Tell us a little bit about how folks can get in contact with you if they need to know more about the Canadian market.
Yeah, definitely. I mean, I'm always available on LinkedIn. I haven't been massively on there. I've been kind of creeping in the background for all of those that usually see me post. I've tried to limit my posting to stop. I started finding myself getting caught up in scrolling, but definitely LinkedIn. You can always email Dan D at pinnaclelogistics.ca. So yeah, either one of those two is a great way to get a hold of me. And you know, Dean, I'll add one more thing. Sorry, I know we got to go, but you know, when you look at these specialized commodities, specialized industries, I truly believe there's industries out there that never saw a freight recession.
Right.
You know, one of them being pharmaceuticals.
Yeah.
You know, and for all of you out there that are hurting, the fact is, it's a lot of the times it's the industries you're in that are hurting you.
100%.
And you know, Dean, we've talked about it many times. It's you know, we get a consensus. You give great numbers on the general industry, but there's some pockets of that industry, like your fresh lobster. I mean, the money that's made there for people is crazy high because there's such a demand overseas. Like it'll go to JFK, it'll probably fly to Asia somewhere.
Yep. There's a lot to be said for a 14-inch drop chrome visor, bit of stainless steel on your wheels. They tell you a lot about how viable carriers are. And the produce haulers and the lobster haulers are doing pretty good by all accounts, if bling is a factor.
If bling is a factor, yeah. When you see a truck coming down the highway with spinners, you know they got a good load.
I saw some of them last week in India. That was
yeah, I bet. I couldn't believe that picture you sent me. I was blown away.
Fascinating. We could talk about that all day. We might do that on Logistics Life this week.
Yeah, definitely. We'll do it tomorrow on Logistics Life for sure.
Couple of shout outs. Professor Kaplis is got his Freight Vine podcast out. He's talking to Ian Jeffries, President and CEO of the American Association of Railroads, about the long-term effect of the railroad dispute and how the railroad is evolving. Very important listen for those that consider the railroad side a competitor of truckload. Next week's show, Ibrahim Bayan from Uveen is on talking about commercial warehousing. I'll be on with Radio Nemo, Jimmy Mack on Thursday morning. Of course, Dan, what time's our show go to air on Wednesday?
10:30.
10:30 Eastern.
10:30 Eastern on Wednesday, the Logistics Life.
Got it. Make sure you set up alerts for our live show and subscribe to our channel on LinkedIn and YouTube. And with that, another show is in the books. Thanks for watching. Be safe and be nice to everybody. We'll see you next week at 10 a.m. Eastern, 7 a.m. Pacific. Have a great week, everyone.